So let's calculate the risk-free rate under different scenarios. Your currency is not US dollars. Now how will you calculate a risk-free rate in your currency? Let us understand this with a case study. The Indian government has a 10-year rupees bond outstanding with an interest of about 5.92% on 1st January 2021. Now is this 5.92% your risk-free rate in Indian rupees? Absolutely not. Why? Because India as a country has a risk that it can default on its debt. Remember, India and US are two very different countries. So how do we calculate that risk-free rate in Indian rupees? We deduct the risk that the India will default on its debt from its 10-year rupee bond rate. How will you do that? How will you calculate the risk of India defaulting on its debt? To do that, there's a huge market called credit default spread market, or CDS market in short, for government bonds, which denotes on real time the risk of entire countries defaulting on its debt. And it shows the credit default spread net of US. Let me show you what I mean by that. The United States US 10-year government yield is 1.618%. Now, when we compare this yield to, let's say, Canada, the Canada 10-year government yield is 1.633%. That means Canada as a country as a whole has a 1.5 basis point risk as compared to US that it will default on its debt. So this spread, this default spread denotes the risk that Canada can default on its debt as compared to US. However, we have a problem. The Indian government bonds are not traded in this CDS market. And for that purpose, what can we do? For that purpose, we take the average default spreads, which will be incommensurate with sovereign ratings issued by S&P or Moody's for India. Now what I mean by that? Moody and S&P give credit ratings to countries. What we will do is we will use Moody or S&P rating as a proxy for the risk that a country will default on its debt. Now the local currency sovereign rating of the Indian government is Baa3 by Moody's. So what we will do is we will take a typical default spread for a Baa3 rated country over a default free country like US. What I mean by that? What we are basically doing is we're taking a AAA rated country like US, and we are taking another countries which are listed on the CDS market and checking their Moody ratings. And when checking their Moody's ratings, we are checking what is the default spread of that country in the CDS market. Now we see that India has a Baa3 rating, and the default spread for such countries which are listed in CDS market and have Baa3 rating is 1.95%. So we are basically using the average spread for other countries with the same sovereign rating. Hence, in our case study, the risk-free rate in Indian rupees will be the Indian currency government issued bond rate 5.92% and the default spread, that is 1.95% for a Baa3 rated country. And the risk-free rate in Indian rupees will be 3.97%.